Hello, and welcome to Macro Minutes. During each episode, we will be joined by RBC Capital Markets experts to provide high-conviction insights on the latest developments in financial markets and the global economy. Please listen to the end of this recording for important disclosures.
Hello and welcome to an Antipodean edition of Macro Minutes. I'm Rob Thompson, Australian Head of Economics and Rates Strategy, and with me today is Mary Jo Vergara, our Senior Economist for Australia and New Zealand. We are recording this at midday Sydney time on the 15th of July. So we've just been through a quick-fire hiking cycle from the RBA. It took rates back to their post-COVID peak of 4.35 after three back-to-back hikes through Feb, March and May. And now we've just had a first hike from the RBNZ last week.
Don't remind me, Rob.
Yeah. Now, they hiked from a much lower starting point of just 225. This was their first in 3 years, though. Now, given Iran and renewed global inflationary fears, we've had plenty of other banks tightening again already, not just the Reserve Bank of Australia. MJ, what took the RBNZ so long to join the party?
To join the party.
Not your expression.
Yeah, let me first apologise for how I was maybe on the day. I was probably not the most cheeriest of colleagues sitting next to you.
I've seen happier faces.
I mean, arguably, I don't think they needed to join the party, not yet at least. We always knew that the next move in the cash rate would be up, but we were favouring no change at the July meeting because, quick history lesson, New Zealand, the beautiful country at the bottom of the world, had a really deep recession in 2024, and on a per capita basis, it looked even uglier. It was both deeper and more prolonged than during the GFC. So the cash rate was sitting below neutral when the Middle East conflict kicked off, which is where it needed to be, because of how weak the economy was. And it looked like stimulatory policy was beginning to work, but the economy in its recovery was very much in its early stages. So that's kind of the starting point. It's weak, but the RBNZ seemed to be concerned about the risk to medium-term inflation from this conflict, and they're concerned about the price-setting behaviour. We'd argue that the risk of persistence is quite low, given that there is little evidence of a wage price spiral forming in New Zealand. Unemployment's high, wage growth is at 2%, which actually, if you unround that, it's 1.97%, so it's pretty weak. And household demand, when you layer on rising mortgage costs, which have already lifted before the RBNZ even hiked interest rates, and you've got house prices going nowhere, household demand is pretty weak. And so that should limit any pass-through of higher input costs. And then also, if I haven't mentioned already, there's an election at the end of this year. So that uncertainty just adds to everything. There's a lot of headwinds that the New Zealand economy is facing, but the RBNZ is just very focused, I guess, on medium-term inflation.
All right, so I'll definitely strike all talk of a party from the record here. My apologies. I'll try to ask things a different way then.
Yeah.
Why did they switch so quickly from sounding happy enough to stay on hold in April to a split vote in May and then a consensus hike in July?
It is interesting. It's kind of like meeting this year. They've shaken off their dovish feathers and grown some hawkish talons with every meeting. I think the decision itself to hike was not surprising. It was 80% price going into the meeting. But the fact that it was a consensus hike was unexpected, I think, especially given the fact that there was really little data between the May and July meetings for them to fundamentally change their view. But I think what it is, it's just the fact that during this conflict, as this conflict has been playing out, they've been sitting there with a stimulatory cash rate, and they're just uncomfortable with that at a time when inflation is already above target and will potentially move higher from there. They just don't want monetary policy to be adding to any inflationary pressure. Basically, they want monetary policy to be one less reason that's keeping inflation above 3%.
Okay, so you mentioned the stimulatory cash rate. How about broader financial conditions? Those were mentioned in the statement. How did that play into their thinking?
There was a section kind of dedicated to that. They've seen a recent easing in financial conditions, which is a key reason behind the hike. Rates in New Zealand are still higher than pre-conflict, but they had fallen back in recent weeks, just with that global repricing after the MOU had been signed, and expectations of central bank tightening had kind of pared back a little bit, and Kiwi rates were following that move lower. The Kiwi dollar had also weakened in the weeks leading up to the meeting, so the MPC seemed pretty concerned about the implications that has for import inflation rising with a weaker currency. So it seems like the RBNZ is showing little tolerance to any and all upside risks to inflation. So I think there was an element of kind of shoring up financial conditions, making sure that they stay tight as a reason for them to hike, to kind of prevent a rally in rates that might have happened, even if they delivered a hawkish hold instead.
I guess that makes sense given what markets had priced in. Look, they obviously didn't have this data in hand at the meeting itself. Subsequently, we've had a few pieces of strong information coming out, including that 10-point jump in the PMI. Also, fairly strong performance of services come out post as well. Do you think the further reaction to those indices is justified, given we had a further sell-off in rates there?
It's good data. It shows that the recovery that was starting at the beginning of the year is resuming. So it's good data. But I think that PMI jump was maybe more reflective of the resilience in overseas demand, particularly China, which is New Zealand's largest trading partner. And that's obviously been helped by a weaker Kiwi dollar. So I think it's kind of showing that if you look at more of the domestic indicators like the PSI, which is more of the services, right, that had also improved, but it's not shooting the lights out like the PMI showed. And actually some card spending data, which came out recently as well, that declined over June. So that kind of tells you, it kind of paints this picture of a patchy recovery where, again, it's this external facing, doing quite well. Internally, domestic demand is still quite weak and obviously hit by this conflict. So the data's good. We'll probably get that rebound in activity that's expected over the third quarter. I just wish we had a little bit more time before they started normalizing policy. This recovery has been long forecasted, long awaited, and I just wish that we had more time to kind of regain momentum before they started hiking rates. But markets, they're taking the data as confirmation of further rate hikes from here, and it's kind of hard to argue against that,
Yeah, okay. I mean, I could probably guess your answer to this question, but we'll need to ask it anyway. Boiling this all down, would you say this hike was necessary, or is there still a strong dovish case to be made?
It's necessary eventually. Again, like we said, the next move in the cash rate was always going to be up. It was just a difference in timing, and it's classic RBNZ front footing. Front footing is the strategy, and I can stand on my soapbox all day and say what they should be doing, but you kind of have to play the institution, not the game, and they've made it clear that they don't like the cash rate being below neutral. So that seems to be the path forward, is going back to neutral.
Okay, well, I'm going to ask you to get back up on that soapbox and give us a formal take on where you think the OCR will be a year from now and how it differs from where it should be.
Yeah, a year from now, I think those two might actually be one and the same. The cash rate will likely be at least 3%. Again, it's chartering back to neutral, which is 3%. I think the risks, though, are skewed to the upside, given that there is some discussion at RBNZ that the neutral cash rate maybe is higher than where they previously estimated it to be, which is around 3%. But I think the important point to make here is that in a year's time, it should be going back to neutral. I think what they shouldn't be doing is tightening policy. I think, as we've described, the domestic economy I think, would struggle with restrictive policy. Going back to neutral is something I can live with.
Okay, even if you think the path there perhaps shouldn't have been quite so fast.
Yeah, maybe it's just waiting another couple of months to get that recovery momentum back. But yeah, we were all in agreement with where rates should be going. It's just the timing issue. Okay, I'm getting sick of the sound of my own voice. Let's move. Let's fly 3 hours across the Tasman Sea and switch over to Australia. You said at the top of the show, Rob, that the RBA has almost taken a page out of the RBNZ's book and have gone back to back to back, 75 basis points of hikes in 3 straight moves. 435 cash rate. Do we reckon that's a terminal?
Look, at this stage, we're thinking it is. But, I mean, we started this podcast on New Zealand for a reason. RBA has been exciting so far this year through those 3 meetings, but now it feels like a bit more of a boring story where, as I said, 435 feels like terminal. The budget coming into the equation as well, putting a lot of negativity, particularly onto the housing front through those tax changes, has felt like a quasi-rate hike added on top too. So, no, we don't think there's going to be any more hiking. But on the flip side, can't see any more cutting until well into next calendar year. It's going to be a pretty boring story unless they are forced to hike again this year by inflation, which we think the odds for that are receding despite a kick-up of conflict in the Middle East recently.
Yeah, I think because we had expected that maybe they go to 460, but that budget has been quite the big change in everything. Like you said, it's a good way of putting it. It's a quasi hike in that tightening conditions more than the RBA needs to do, right?
It's certainly surprised me, the reaction to the budget, just how large it's ended up being. I mean, the changes were flagged heading in via the usual array of leaks pre-budget, and so didn't think it would have quite the sticker shock that it's ended up having. Now, of course, house prices here are always very sensitive to these things, and they've moved a long way. But I guess it is more than that. It paints a bit of negativity into dwelling investment as well in general. And of course, the whole consumption piece of the housing market is softer. Also, a bit of negativity overlaid on top of that as well. So, yeah, I mean, the rate hikes have been a bigger dampener earlier in the year, but that budget's kind of really taken over that narrative more than I would have thought heading in.
Yeah. I mean, it wasn't too long ago that markets were pricing in an RBA terminal of around 5%. The budget's obviously been one reason why that's kind of been pulled back a little bit, but what's taken markets from that to just 435? And I think there's about a half chance of one more hike this year.
Yeah, you're right there. I think having jumped the gun before the budget's probably the main reason, which took away from our initial forecast that they'd have to hike to 4.6%. But of course, in the background, we've had those Middle Eastern oil fears recede, notwithstanding the last couple of weeks of additional volatility and shutdown of the Strait and so on. But look, back to the impact of those 3 hikes we've had already, which of course was unwinding the cuts we had last year. The cumulative impact of those on financial conditions more broadly, and of course, we're very sensitive to that cash flow channel, having the vast majority of our mortgages being floating rate, certainly has come through. Growth's been a little bit on the softer side lately. And then, just that federal budget piece has really come in and given us the final straw, if you like, preventing the need for anything further. In terms of the hiking, we still got priced into the curve, which it's oscillated a little bit, again, on oil prices and so on recently. But I think the market is really struggling to price a whole lot more than around a half chance at most, or maybe 15 basis points of hikes the rest of this year, given we are now back to the previous post-COVID peak in the cash rate, with everything else hanging over us. It just doesn't feel like the market can get anywhere near that 5% it was at peak uncertainty.
Yeah. We get the sense now that the focus is turning now to how many cuts we can price for the RBA over next year. What do you think is the earliest we can reasonably expect for an easing cycle to emerge? You kind of said not till the back end of next year. And how many cuts do you think the market can factor in?
So we've had a cut penciled into the fourth quarter of next year for some time, but that's a bit of an off in the distance, something to aim for story more than a fact to look forward to in the near future. I suppose if you'd asked me a few weeks ago, I would have said the earliest you might start to see this get factored into the curve could even be into the first half, even if we don't think that's really going to be the story. We think inflation will be a little bit too sticky for too long for the RBA to cut until, as you said, the second half of next year. But if it wasn't for the flare-up again of the Middle East conflict, I would have thought the markets could actually start to toy with the idea of bringing some of that cut pricing into the first half of the year. For now, that seems to have backed away, which makes sense. And instead, we're now back to this factoring in some hiking in 2026 on the off chance the RBA needs to hike again. And of course, if they need to hike again, the market's going to think, well, maybe it's 25, maybe it's 50. Even if those are low probability odds, that's kind of why we have this 10 to 15 basis points of pricing still stuck in there, even though the broad consensus across the street, and the same as our view, would be that they're not hiking again this year. And that, again, at the beginning of this question, as you asked, the story really is about, okay, well, when do they start cutting at some point next year?
Yeah.
All right, thanks everyone for listening in. We'll leave it there for today's edition, but we look forward to our next installment, and I'm sure there'll be plenty of other Macro Minutes content from the rest of our global strategy team in between.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.